Today, we're diving into one of the biggest and maybe most controversial trends in private markets, the continuation fund. They've absolutely exploded onto the scene as a fix for a huge problem. But are they a brilliant innovation or just a really complicated escape hatch? Let's get into it. So, for the last couple of years, the private equity world has been in a bit of a bind. You've got high interest rates, a really shaky market for deals, and all that has made it incredibly tough for fund managers to sell their companies. And that means the cash that investors, we call them LPs, are supposed to get back, well, it just isn't coming back. And this pressure, it is very real. Investors aren't just looking at gains on paper anymore. They're banging on the table for actual cold, hard cash. This metric, DPI, which just means distributions to paid in capital, has become the #1 thing they care about. It's basically the show me the money metric, and it's forcing the whole industry to get really creative. All of this has created what pretty much everyone is calling a liquidity drought. The usual ways out are blocked, so fund managers are stuck. And that, right there, is the engine behind the massive rise of our topic today. And here it is, the market's big answer, the continuation fund. It's this powerful and kind of complex tool designed to solve that exact problem, generating cash without having to sell a company on the open market. So what on earth is it? Well, put simply, a fund manager, the GP, creates a whole new fund. That's the continuation fund. And its only job is to buy a star company out of one of the GP's own older funds. Yeah, you heard that right. The manager is essentially selling a company to themselves. This lets them hold on to their best assets for longer, hoping to squeeze out even more growth. Okay, let's walk through how this actually works. It all starts with a fantastic company, a real trophy asset that's stuck in a fund that's getting old. Instead of selling it, the GP builds this new continuation vehicle. Now, that new fund needs money, right? So it gets cash from brand new investors and from any of the original investors who want to stay in on the action. And that leads to the most important part. The original investors get a choice. They can finally cash out, or they can roll over their stake into the new fund and bet on the company's future. So you might be asking, why has this structure become so popular so fast? Well, the simple answer is that when it's done right, it can be a kind of win-win-win for everyone at the table. Let's break down who gets what. For the fund managers, the GPs, the benefits are pretty obvious. They get to keep a star company they know inside and out, instead of watching a competitor buy it. They also get to chalk up a successful exit for the old fund, which looks great for their record. Plus, they start earning new fees on the new fund and still get a piece of the action if the company keeps growing. It's a pretty sweet deal. Now for the original investors, the LPs. The keyword here is flexibility. They finally get that chance to turn paper profits into real money in their bank account. But if they still love the company and trust the manager, they can roll their investment over and shoot for even bigger returns down the line, all with a team they're already comfortable with. And what about the new investors who are funding this whole thing? For them, the appeal is super clear. You're not investing in a blind pool where you don't know what companies you'll end up owning. No, you're buying into a specific, well-known, and usually high-performing company from day one. That can mean faster returns and, in theory, less risk. Okay, but for all these benefits, there is a massive fundamental conflict of interest baked right into the DNA of every single one of these deals. The manager is playing for both teams. They're the buyer and the seller. And that leads us to the multi-billion-dollar question. I mean, think about it. If the GP is the seller, they're supposed to get the highest possible price for their original investors. But they're also the buyer, and they're supposed to get the lowest possible price for their new investors. So how can anyone possibly be sure the price is fair? The same general partner is sitting right in the middle, with a legal duty to two different groups of investors whose goals are completely at odds. The old fund wants the price to be high, the new fund wants the price to be low. Juggling this is, without a doubt, the single biggest challenge in pulling off one of these deals. So, how does the industry try to solve this puzzle? Well, over the last few years, a whole playbook of best practices has emerged to manage this conflict. The price is usually set through a real auction process run by an independent third party. Another outside firm will issue what's called a fairness opinion to say, yep, this price seems reasonable. And most importantly, everything has to be super transparent to all the investors, and the deal usually needs a sign-off from a committee of the fund's biggest investors. And you can bet the regulators are watching this like a hawk.
The SEC has literally said that these GP-led deals and their built-in conflicts are a top priority for them this year. They want to make absolutely sure that managers are being open and that the process is actually fair for everyone.
Okay, so let's zoom out. All this activity raises a really big question. Is this whole trend just a temporary patch for a broken market, or are we watching a permanent, fundamental shift in how private equity works?
Well, the numbers are just staggering. $115 billion. That's how big the market for these GP-led deals, which are mostly continuation funds, was last year. This isn't some niche, quirky strategy anymore. This is a massive, mainstream part of the entire private equity world. We're also seeing the market get a lot smarter. You can see it in the pricing. This chart shows a really clear difference based on what's being sold. The single asset deals, the ones with the real trophy company, they trade for about 96 cents on the dollar. But the multi-asset deals, which are often used to just clean up the leftovers in a fund, trade for much less. This tells you the market is getting better at figuring out what these things are really worth.
Now, before we wrap up, I want to hit on a super important detail that often gets glossed over: taxes. A lot of people mistakenly think that rolling over your investment is a tax-free move. But as the experts at RSM point out, that's not really right. The much better way to think about it is tax-deferred.
So what does that actually mean? It means when you roll over, the profit you've made so far gets locked in or crystallized. You don't have to write a check to the government right away, but that tax bill doesn't just vanish. It's waiting for you, and it will come due whenever the company is finally sold for good out of the new fund. And that, for any investor, is a really crucial detail for financial planning.
Okay, so after all of that, what's the big takeaway here? As an analyst watching this market, how should we really think about this trend and what it means for the future? The reality is, continuation funds are a paradox. On one hand, they're an absolutely essential tool for getting money flowing in a frozen market. But on the other hand, they're a deeply complex solution that really blurs the lines of what private equity is supposed to be, creating these huge conflicts. And for now, it looks like the answer is it's both. The industry has decided it can't live without them. So, to sum it all up, continuation funds are definitely here to stay. They solve a huge liquidity problem, but they come with that serious conflict of interest that has to be managed really carefully. They are changing the very definition of a private equity exit. And if you're an investor in this space, the two things that matter more than anything else are transparency and strong governance.
This is not financial advice.